Introduction's now finished. We continue with active versus passive capital management because that's the difference. When you invest and you start to trade, that's the difference we're gonna make. We're gonna make some pro and cons for each of it. What are the biggest pros of passive investment? What most people do that don't trade. I mean, some people don't invest at all, but still it's an investment decision to, for example, just keep the currency of your own country. Most people don't realize it, but also this is an investment decision to do nothing. But let's start with what is a passive investment and what are the benefits of this. It's not really time consuming. So time's limited, you do some research, you do some investment decision. Most of the time they're long term with diversifying currencies, investing in S&P 500s or different ETFs or individual stocks. But that's what most people do. It's not really time consuming, very limited. And most of the times you perform the same the market does, depending on the market you invest in. It does not require really high technical knowledge. When you go into trading, you need to understand data feeds, the different software, what is an MBO, data stream, where do the orders come from, what are the different exchanges, what are the different types of orders. When you do passive investments, you don't need to learn about all the stuff. We're going to explain later in the course. So you just take the basic Neo broker or any broker you find, or even the broker of your bank, and just invest through there. Most of the time, very easy, very good customer support, and not very complex. And third, you have less emotional impact. When you trade in the beginning, there's going to be a big topic about this with matching personality and emotions. The emotions you have while you trade are there. The longer you do it, the less they get, but you need to work with yourself and realize those emotions. Because everybody of us, most people, I would say 99% of us have a connection to money, an emotional connection to money, because we connect something with money. Either it is freedom, it is safety of the family, it is good food, it is a holiday, it is a good car. Whatever the individual connection is, you see things you can buy or benefits money gives you or you get from money. So you see when capital is positive, most likely you have positive emotions. When you lose money or capital is negative, you have negative emotions, you feel stress, you feel maybe anxiety. So when you do passive investments, yes, you also have an impact because when the market crashes, you also realize it because the information of a market crash will reach you, but it is way less than trading. So it's more like a roller coaster than trading. And when you invest passively, it's more like a highway, and sometimes there's intersection and you need to change the highway, but it's not as much as a roller coaster going up and down. So what are the cons of passive investment? The returns are kind of limited. With passive investments, or to outperform the market with passive investments, kind of unlikely. Of course, it is possible. It also depends on what market you take as a reference. If you live in Europe, if you take the Euro Stoxx 500 or the DAX, or in the US, you take the S&P 500. But if you do or decide for less investment decisions, of course, if you have a lucky pick in NVIDIA, it's going to be a very good passive investment, but most of the times the outperformance is very limited. So you do less performance than with active trading decisions. Of course, it goes in both directions. When you do more trading decisions, you have more commissions. You also have most of the times a higher leverage, and you can also lose way more money with active trading, of course, but also, and that's the goal to the upside, you make way more performance in the short term because you're not as dependent on the market as you are with passive investments. You have less ability to hedge or adapt to adverse market conditions when you do passive investment. Of course, you can hedge, but also this impact gonna be way less. And the possibility to adapt to adverse market conditions, for example, when there's a big COVID crash or oil prices went negative, it's more unlikely because you're not as deep into the topics or into the markets or in the things that happen, that the delay most of the times is too high until you get the information that something happens. Then you build a strategy, analyze, and implement this in your passive investment. So the likelihood of you being hedged for big macroeconomic events, start of wars, whatever, is less. And you need a lot of capital to sustain a lifestyle out of the yield because you make less performance. because you make less performance. Your account is not really growing if you take out all the performance, and you just made less gains. So it's gonna be more difficult. You need more capital to live or sustain your lifestyle out of passive investments. So the competitor to passive investments is the active trading. What are the pros of that? You can, like I already explained, make higher returns because you are more flexible. You can cut out the small pieces out of the markets and don't just take the gain over a long period. You can take advantage of adverse market conditions because it's very likely that you are at the screen or are in sync with the markets when these adverse market conditions happens, like somewhere a war starting or COVID is kicking in, or there is trouble in a country because of the politics or because of the society. And it's very likely that you are there, so you can take advantage of this and react individually. And in trading, you're always up to date. When you do passive investments, it's more unlikely that you update yourself regularly. Most people that do passive investments get information about their investment, currency, stock, whatever, through push. So if something happens, it pops up in their feed, but it's not about trying to get data about an investment decision regularly. What you're doing through trading, you're always looking to the news. You're catching up on the news. You're checking what's the next news that's going to get published. When there's a big topic that happens, you get through your news feed, you get direct information notification, what happened, and then update your investment decisions. So you are more in sync with markets and you're always up to date, which you are most of the time not with passive investments. What are the cons? You have a very high risk of failure. Yes, you have with trading. Most people lose money trading. In some brokers, it's 60%. On brokers with conflicts of interest, it's 80, 90% because it is a very hard game. And you know your competitors, we explained them already. The risk to fail in active trading is way higher than in passive investments, so you need to decide for yourself if that's worth for you, but most likely you decided that you want to step into this game and master it. That's why you are here, but it's still important to know this. You have a very long learning curve. It's unlikely, or not a lot of people step into trading and are profitable from day one. It's a learning curve. You need to learn strategies. You need to learn different markets. You need to test yourself. You need to test what's good for you, what markets you like, what way of trading you like, and also what works. And then also realize the psychology, realize fear and greed. All of us humans have it. How to manage this and how to realize this and how to use it for trading and not be too much influenced by those emotions. And trading is time consuming. If you trade actively, you spend a lot of time in front of the screen, you spend a lot of time learning, and you spend a lot of time actively trading. Of course, the further you go, the more you study, the less it's gonna get. Except you're scalping, then you're still a lot of time in front of the screens. But the more you get into your routines, the more you get into your process, and the less active you need to think about, the better it's gonna get. But in the beginning and also while trading, it's very time consuming.